What's up, guys? I'm Sean Weldon, the creator, builder, and engineer of the Atlas engine. I trade options and futures daily, and I created this channel to essentially talk to me 3 years ago about all the things I wish I knew and all the tools I wish I had. I back up all my trades with data and frameworks that actually work, tools I actually use, and I'm here to share my story, my edge, and a few of the lessons that I've learned along the way. So if you're into creating a income generating portfolio, scaling your portfolio, or just looking for extra edge, you've came to the right channel. Let's get it. All right, rolling for a credit. What does that mean? What does rolling mean, and what do you do when you roll for a credit? So I've created a playbook on a few rule sets and a few things to use when you're deciding whether I should roll or close a position. A lot of traders, when a trade goes against them, they get scared, they get nervous. When they see the red P&L, they freak out and they close the position. But what real traders do is when a position starts going against them, they manage their portfolio and they manage the position. They don't close it for the loss the second they see some red. So let's go over a few things. Rolling is closing a current position and you're going to open up a new one in a further expiration or a different strike. But the key is to always roll for a credit, not a debit. So you want to collect more premium on top of what it costs to close. So if you have a $2 credit, it's going against you, and you roll, you should be getting 20 cents, 50 cents to now make it a $2.50 credit instead of decreasing your credit. So a lot of people are wondering, or I'm sure you're wondering, why roll? So you're going to extend your time. So when you sell credit and you sell premium and you're going to sell options, time is working in your favor. Now, if time's coming up to expiration and the trade is going against you, you want to roll either out or you want to roll out and away. So out being in time and away being away from price. So this gives you a large theta advantage, and that's what we're going for here. This isn't the only strategy you would use, but as you're implementing multiple strategies like I have in my Atlas engine, theta decay becomes a big resource to you. So when you're trying to maintain credit or keep credit, you want time to tick away so you can keep that credit that you were just given. The probability of profit is a good metric to stay with. So as you adjust your trades, your probability of profit should stay in a good range of 80%, 60 to 80%. And that's what you're doing when you roll. You're going to maintain your your delta exposure, and then you're going to adjust your probability of profit. And when does this work? High IV, tested positions, and time left before expiration. So when you have a good amount of time left, you should be rolling to adjust your position. When you're coming up on a expiration, 3 days, 4 days, something close to that, it might not make sense to roll because you might not give enough time for price to move. High implied volatility is another marker. So if we're at a 30 IVR rank and all of a sudden the IVR rank jumps to 50 or 60, we want to take advantage of that new premium, the new implied volatility. It's going to increase our premium. So then we can capture more premium once implied volatility rises. So there's a few types of rolls. We're going to go over that in the next slide. So we have out in time, like I just discussed, where you're essentially harvesting theta. You want time to work for you, so you're going to maintain the same strike, but you're just going to push it out in time. And you always want to go for a credit. Out and down and or up, what I was just talking about. So now it's time plus the strike moving. So here you see that it's credit or neutral. So not a debit. You want it to be at least a credit or just no change in the position. So this is when the direction is really moving against you and you need to adjust the price and the time. The next one's going to be an iron condor roll. You're essentially just recentering the range because you have two credit spreads. You have a call spread up top, put spread at the bottom, and you want price to stay in the middle because max profit is in the middle. And then we have the untested side roll up. I wrote roll in. This is a strangle defense. All right. This is only used when you have two naked positions and you want to collect more credit. You're going to roll the untested side up. All right, let's take a look at the option chain and let's see how this works in practical example. So we'll come over here. These are the positions I have on the euro. I have a 20 DT put spread and a 48 DT put spread. So now what I want to show you is rolling. So let's roll the 20 DTE. So I want you to focus here, and this put spread right here is at 20 DTE. All right, so say I want to roll it out in time because price is testing my point. So what I'm going to do is Tasty Trade makes this really easy. I'm going to click both of these, just the 20, and I'm going to roll expirations. So now take a look here. What we see is we see the expirations with the credit, right? So you see 90 credit if I roll to the 48 DTE, so forth and so forth as we go down the line. Here's the credit, and here's the DTE that you're going to be looking at. So this makes it very easy, but let's look what it looks like on an option chain. All right, so let's roll. Let's do a quick roll. All right, so my current position, I'm selling the 113, I'm buying the 112. All right, so if I want to roll, I want to keep the strikes the same, and what I want to do is I want to push the expirations out. So we're going to push the expirations out in time, but we're going to keep the same strike. All right, this is called just rolling out in time. We're giving ourselves more time to be right. That's the whole point. Markets fluctuate. They go up, down, they consolidate. So if price is starting to head into our price point, like so if price is coming up, down, up, and it's testing our short strike, we can either close the position or we can wait for price to move away from our short strike. So when price is approaching and time is dwindling, we roll out in time. Now let's look at rolling out in time and rolling away. Very simple. We just move the strikes from here to here. That's it. That's all we did. We rolled the short strike to here, and we rolled the long strike to there. That's it. That's all we did. All right. So that is rolling out in time and rolling out and away. Now let's take a look at the strangle defense. So if we come here to a new ticker and we're putting on, let's do a shorter distance one. If we're going to put on a strangle, a short strangle, then so here we're selling, right? Selling and selling the 62.65 strike and the 63.65 strike. So right now we have a naked strangle. So let's say price is here at the moment, right? So that's price. So if price starts pressing right here, then what we could do is we're going to roll the untested side, right? Because price is testing this side, and we're going to actually roll it up for more credit. We're not going to worry about this until we have a certain set of rules that are going to tell us when to roll. So if this whole thing was very wide, we had a very wide strangle, and price starts moving up, 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 then what I want to do is I want to roll this side up. We're not worrying about this side for now. We only want to focus on rolling the untested side up if price wants to keep running higher. That's rolling the untested side for more credit. Got it? Perfect. Now let's move on. Let's go back to the slide, and we're going to go to rules to the rolling. So like I said earlier, there's a few rules that we're going to wait and abide by to tell us where to roll to, when to roll, and how to roll. Let's go over the mechanical triggers. So a big one that I like is when the short strike is actually breached, right? So when your short strike, so let's go back to the option chain, and we're going to see, so let's imagine price is starting to head up. It's heading up. Price is acting like this, and we actually breach through Price is heading up, price is heading up, and we actually breach through the actual price. Once we do that, there's going to be a mechanical trigger that's going to tell us to roll. So that's the only time I roll is when on a short strangle is when price actually broke through my short strike, right? And my short strike's right here. That's when I'll roll, is when price gets up here and I'll start looking to roll. If price comes to my short strike and then consolidates and then heads away, I'm not going to roll. All right, it's when it's a full breach, just like this right here. All right, so let's move on. Let's get back to the slide. If we're short strike is breached or we have 30% loss in premium value. I don't like the 30% rule. It's a good rule for beginners. Sometimes I let it go to 100%, but it's only based off technical analysis and a few other keys that I like to take into account. This is a pure mechanical trigger if you're trading on algorithms or automation like I do sometimes. So also another trigger, underlying hits 1.5 expected move. Let's go back over to the option chain. This is the expected move right here. This is the expected move. We can also find the expected move up here, right? Plus or minus 24.25. That means that with price being right here, that price is expected based on probabilities and math to only move here to here. That's why it's a plus or a minus, right? If price gets to about 1.5, the expected move, and I have a short strike at the expected move, then I'm probably going to look to roll. All right. So if this strike was right here and price started coming up here and we're here and this becomes the 1.5 of the expected move, I'm going to look to roll or even start to figure out what I'm going to do with this position. All right. Now, the last one is going to be gamma risk less than 7 DTE. So if you're under 7 days, that's the trigger to either to roll to 21 days or to 30 days. Next one, credit thresholds, minimum 50 cents credit when you roll at least for 45 DTE. You can't be rolling for 10 cents, all right? And always, always, always roll for a debit. I mean, never roll for a debit. Always roll for a credit, all right? You don't want to have a debit. You always want to be gaining more credit so that the time decay can work in your favor, all right? And last but not least, rolling versus taking the L. Don't keep throwing good money after bad moves. Preserve your buying power. Every time you roll and take on more credit, you're going to be giving up buying power. So when you roll, you need to understand, is this working in my favor, right? So let's go to the option chain and let's look. So say we're in a bull market, all right? And we just sold a call. Let's look at what this looks like on, here we have the 6320 call. And say we're in a bull market, right? And price is just moving, 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 and we are not retracing one bit. That means right here on this option chain, price is moving this way. All right. So if price is moving this way in a bull market and I'm stuck with a call, meaning that I want price to go down because I sold a call and we're just continuing to rip, this is throwing good money at a bad move, right? The top will come eventually, but at what cost? All right. So that's what it means when you're throwing good money after a bad move, and especially in a bull market when things can just keep running. So let's look at strategy specific rollings. So the strangles we talked about, which are naked strangles where it's not a defined risk play, it's the most maximum amount of risk you can take on. What we're going to do is we're going to roll the tested side. All right. This is key. We're rolling the tested side for a credit, and we're rolling the untested side again to collect more theta, and we're going to recenter. So the standard, right, is to roll the tested side like I spoke about earlier. But with strangles, we're also going to roll the untested side because we're going to add more theta and we're going to rebalance. So let's look at the option chain. I'm going to add a short put, and let's look at the curve. So here we have this nice little payoff probability distribution. So let's imagine that price is coming to test the call. Right? Price is coming to test the call. We're going to roll the put. This is the untested side. So what we're going to do is we're going to roll this up for more credit. And then as the tested side gets, we're going to, let me rephrase this. We're going to roll this strike up. We're going to roll the strike. And then on this one, we can always just roll out in time. All right. So we're going to roll the strike on the put, and we're going to roll the time on the call. Understand? Good. Let's get back to the presentation. Condors. I don't do many condors, but we're going to roll the entire position out to recenter, or we're going to just roll one wing at a time if it's really skewed. And say we're in a bull market, the call's getting tested, we're just going to roll one at a time and let that put sit. Credit spreads, same idea, just as this is defined risk. So if the spread gets hit, we're going to roll for width and duration. So let's look at what that means. What does width mean? So let's go back to the table. So let's do a call spread, all right? So this is a call spread. We're selling a call above price. This is price, right? We're going to sell the call above price. And what we're going to do after that is we're going to put on a safety mechanism, which is buying above price. So when we're talking about a credit spread, this is a credit spread right here. All right. So we'll take a look at some key factors. This is a credit spread. Why? Because we're getting a net credit. Right now we get 90 cents. Usually call spreads give you more premium. We're getting a $90 credit to put on this spread. Now let's widen the spread. Let's increase the distance between the short strike and the long call. So now that we have this little gap, we have a 10-point, right? We have a 10-point spread right here because we have the 25 and the 35. That's going to give us a larger credit, which instead of a $90 credit, we get a $150 credit, tying up 845 in buying power. This is a credit spread. I love credit spreads. Defined risk. All right. This is defined risk. Your risk is the width of the spread. Max profit 155, max loss is 845. Obviously, we're not going to let the max loss happen. That's why we roll. So when we talk about rolling the width and the duration, we can always close this position and open up a new position with a larger width, right? So we have 10 point. We have 10 points here, and we have 20 points here. So this is going to be a larger spread than this one. So that's what we can do. We can always widen the spread and we can push it out in time, right? We can keep going in time with DTEs. Now we're at 4 DTE, then we're at 3, then we're at 2. So we can always push out in time and increase the width. Now another favorite tool that I use is hedging the credit spread with hedging the credit spread with micro futures. So let me show you guys what I'm talking about. Here we are. So if we have a credit spread and we sold a call here and we bought a call here, this is our spread, all right? Credit spread. If we have our credit spread here and price is down here and making its way up. If we see some type of price action that's occurring in this area and we want to get long, I can always just trade right here in this box. I can always buy. Let me write this down. I can buy a contract or I can buy long call for price to go up. So if I have a credit spread and price is heading towards my spread, if I have a call spread up top, meaning I want price to go down on this credit spread, but price is heading up, you can always just buy a contract, profit from price running up, while simultaneously profiting off the credit spread as the price stays below my call spread. I know that's a lot to handle, but if we're bearish here, if this call spread is bearish and price is heading up, I can trade price, hedge it with micro futures. As price is heading up, I can collect profit all while everything is maintained under my credit spread. This is my favorite strategy and I use it all the time.